Okay, I think we can start now. Welcome to KSB's Insight. This is the fifth webinar in our series of webinars and talks on the COVID issue. These are challenging times. Oil went into the negative. Who could have imagined that? IMF calls it the Great Lockdown, and they think that the recession would be as bad as the 1930s. So to discuss this, very delighted to have once again on our webinar Dr. Salman Ahmad. He's the Chief Investment Strategist of Lombard Odier Investments. Prior to that, he was an economist at Goldman Sachs, at Barclays Investments, and at EDF Trading. And we also have Saad Siddiqui, who's the head of EMEA strategy at JP Morgan. And prior to that, he has been an economist at, I'm missing one of the buy-side place, but at Credit Suisse. The purpose of this call, thank you for coming on the show. The purpose of this call was to get a view on the global markets and the global economy from you, Dr. Salman, and then focusing on the emerging market outlook from Saad. And we still, like the previous calls, the format is we have a 40-minute discussion, a 40 minutes window we'll have the discussion for 30 minutes and then open up for Q&A. Dr. Salman, would love to kick off with you. It would be great if you can give us your assessment of what's happening, especially what's happening with the US economy, the global economy, and with oil. What does negative oil mean? Why did it happen? And what does it mean for the future? So over to you, Dr. Salman, and then would love Saad's view on the emerging markets after that.
Excellent. Thank you very much once again for inviting me over, and thanks to Saad for joining us as well. So let me start with oil first, because obviously it's top of the mind at the moment, and a lot of questions about what's happening in the oil markets, and then I can share some thoughts on the global economy, especially the US. So what is happening right now in oil is a spot glut issue. So what is basically being done is that we are testing the logistical constraints of the oil market. So it is less of a financial issue; it's more of a physical oil issue. So let me explain. So when we saw oil WTI go into -40 almost a couple of days ago, this was this expiring contract. People may have heard about the May contract. So WTI has this feature that you have to take physical delivery of that oil, and it is only available in one location, which is Cushing. And we had data, showing that storage was getting filled up because, as you know, because of the shutdown and the lockdowns, the peak demand destruction for a short period of time is running at around 30 million barrels per day. So OPEC cuts, which are being obviously discussed and have been confirmed, are actually starting in May onwards. So in April, we are still going full steam ahead on production. So what we saw basically was that a lot of traders starting to get out of those contracts so that they don't have to take delivery of oil next month at Cushing. And it reminds us, this negative price, is that oil is a commodity. It is not an asset. So there is a negative cost of storage. So if, for example, you can't go to zero like an asset, in fact, you create a liability on oil, i.e. in the form of negative price, if you do not have space to store it. And that's exactly what happened. A lot of also discussion on the role of ETFs and retail investors in this contract. So there are a lot of technical moves happening. So Interactive Brokers, for example, came out today saying that they are suffering a loss of $88 million because retail investors forgot to roll the contract. And in fact, they are forced to get out of the contract at settlement so that you don't get physical delivery. So there is these technical issues which happened on oil on the WTI. But what it has done is that it has shaken confidence. And what you see now is that people are asking that a similar position can happen in June. So you see the June contract now starting to get into a lot of pressure we saw over the last 2 days. And also Brent, which is actually a confidence issue, because unlike WTI, Brent can be delivered in different locations, and it's a seaborne oil, and also it's a financial contract, so you don't need to take physical delivery. So what WTI moves did was that it has actually destroyed confidence, at least in the short-term physical market, that it's showing that we do not have the capacity to store it. It's a great environment for anybody who has storage and anybody who can produce and generate strategic reserve capacity. Because what we do think is that because of these moves, and unfortunately because of the OPEC decision to start a price war at the worst possible time, you may actually have a situation where oil goes to $75 in the next 12 months. The reason is that you will destroy a lot of supply. And if you look at the composition of demand of oil, the major part of oil demand comes from automobiles. So the only sector we see faces permanent or semi-permanent damage is the airline sector. In fact, what we think is that the automobile demand will shoot up rapidly once the lockdowns are over, and they are a major chunk of oil demand. So you may have a situation where oil actually supply falls 25-30%, and permanent damage to demand is only 10% because of lower activity or because of the airline issues. And we should also remember in airlines that even if flights are 50% capacity, you are using the same amount of oil. So if you have to do the route, you have to use the same amount of oil no matter how many people are on the flight. So we have to think about these things. So it's unfortunately a very negative development for the industry. It's testing logistical support. But I think the read-through we should have is that, like in 2008, if you remember, we went to $150 oil, and that actually incentivized so much supply that we actually collapsed, and we got a permanent damage on oil, on oil prices. So we never went back to those levels again, because shale came through because of the very high oil prices. Because at that moment in time, like for example, in 2010, a lot of players who were coming in had a marginal cost of $80, $90. So, they were still making a lot of money. So the reverse is happening. We are going to see a situation where we will get significant destruction in supply. We may see, these OPEC cuts running for a long period of time, and in fact, maybe topped up. And once demand comes through, especially through the automobile sector, which is, as I mentioned, is the biggest part of demand, we may have a reverse squeeze, which may happen in oil. And what we see is that the long end of the oil curve is actually quite well behaved. So a lot of the speculative players have moved their contracts up the curve. So, people are looking at December 2023, December 2022 contracts. Their volatility is much lower. And what you see is a massive, massive contango at the front of the curve because there is no storage. So we have to read oil very, very carefully. The spot oil is not an indication of a very weak market. What it is basically telling you is that there is a physical constraint on the market, and because it's a commodity, you have to basically pay to store it. But it will damage the players who are coming into the spot market and will be shutting down. And once the lockdowns are over and automobile demand comes back, airline demand goes back to 50%, for example. In China, right now, airline airline capacity is running at 50%. You are going to get a very significant bump up in demand from very low levels. So we have to be very careful that this is a very limited bounty. And in fact, the more the oil remains at these low levels for the next couple of months, the more the probability that we'll have a proper squeeze at the end of the year because of the supply-demand imbalance. Remember, this is all about demand and supply. Nothing matters. You may fall from 100 million barrels demand to 80 million barrels, and oil will maybe 100% up. Why? Because supply may have fallen, very rapidly. So please take this into account carefully. This is also a lot to do with the oil contracts, specific oil contracts, and also the confidence shock we are seeing. And last point I would mention, and then I can share with you on the global economy, is that if you look at oil equities, the big oils, their beta or sensitivity to oil prices running at zero almost right now. So oil equities, the big oils, are not responding to this physical issue. They have their own capacities which they can use, and then also the fact that the average of the curve is 25% higher than in March. So even though the spot is negative, the average of the curve starting from, let's say, July onwards is 30-35% higher than March. So the market is already lashed onto it, and I think there will be a significant probability of a major squeeze going forward. So in the short term, yes, you may see very, very low oil prices, but it is no indication of what will happen once demand comes back online. So this is something I want to share, and these are very technical market, and unfortunately the involvement of retail investors, especially in the USO fund, has exacerbated these moves we are seeing currently in some of these contracts. So that's on oil. Obviously, happy to take any questions in the Q&A session on that. But let me share on the global economy. So on the global economy, I think there are two forces right now. The discussion is obviously when to ease the lockdowns. We know Q2 is going to be really bad. Our own forecast for US economy is minus 35% contraction on the quarter, which is higher than the consensus. Of course, the uncertainty around these numbers is very, very high. But what we should remember is that you will see unemployment rates shoot up. You will see, initial claims of the labor market indicators showing significant amount of stress. But we should also remember that there is a significant amount of fiscal stimulus which the US government has put in place. A typical household will receive around $3,000 check. On top of that, you have the small businesses loans which are being deployed. There have been some question marks about whether they are reaching the right people or not, and there is another top-up now coming as we speak. So the intent and the motivation here is to bridge this period and make sure that as many companies survive as possible, and the focus has shifted from growth to employment. So there is a lot of focus on employment right now, even in Fed policies, which initially were targeted towards making sure that we do not get these doom loops whereby dollar becomes the reserve currency, and everybody starts hoarding dollars, and that destroys the whole system. I think they have done a lot to make sure that dollar is widely supplied. So I would just again mention that any currency which is linked to the dollar is frankly out of sync with realities. Dollar is not an FX rate at the moment. It is more of a reserve currency angle, and the Fed is making sure that everybody has dollars who need it. It's like an essential item right now for the financial industry. So that is basically I think has done a lot to bring volatility down. So we see in our indicators that around 50% of retracement in volatility across the board, and even in equity markets, the moves have changed from 9 to 12% daily to 3 to 5%, which are more normal like moves. So going forward, two things will be critical. Once, obviously the timing of these lockdowns and how they are moved. Our view is that they will be sequential. They will not be like a 0-1 type of situation. It will be done in a sequential manner, supported by testing and track and trace. So those things are going to become very, very important. We know that the vaccine is not here, and I think testing and identifying clusters will become important. But those sectors which are exposed to physical proximity and need social proximity are going to struggle, especially in the consumer and leisure side. And another critical question is what happens to this $3,000 or £2,500 which have been given to people in the UK, or $1,000 in Japan, irrespective of who you are. If people save that money, then we have a global depression type situation. The critical thing is that money is spent. And obviously it is important for EM as well, because that part of that money will be spent on imports, but that will be critical. And another risk factor is this US-China tension, which is starting to build up again. There's a lot of populism right now. There's a lot of nationalism right now. So all those long-term trends we were seeing of US-China world order will actually escalate out of it. We're already seeing that, and essential item supply chains will be reassessed. There's a lot of talk about it. Already have started on medical products and food. So those are some of the longer-term trends. But for the short term, the critical part is what happens to these dollars or the pound and the yens, which have been given to the consumer. Do they spend it or not? And in China, there has been some positive news that if you look at the survey data, that they are thinking of spending, but retail sales numbers in March were pretty bad, even though the lockdowns, over by first week of March. So April will be important, but it will be very important what is the impact on the psyche of consumer, because they are the major driver of growth in the global economy. The last point I will mention is on the financial liquidity side, and things are much better. The central banks have indeed saved the system, and I would again point out that dollar is not a currency at the moment. and it is going to be a big mistake to measure yourself against the dollar right now. It has huge amounts of technicalities, just like in the oil market, which are not related to normal FX moves still at the moment. So with that, I would just hand it back to you, Ali.
Thank you. This was very insightful. And I remember the last time we spoke, which was in the midst of the peak of the crisis and volatility was spiking. You was even at that time, you were very positive and you thought that the intervention by the state banks and the Feds would save the system. So hats on to you for making that rather contrarian call at a time when everything looked much more gloomy and doomy. Saad, over to you. Would love to get your assessment of what's happening in emerging markets in general, and a few questions which are particularly dear to me and I suppose to the audience who has joined the call. How do you see the debt issue, the rising debt in emerging market space in general, but Pakistan in particular? And B, do you have any views on the effects? I know Dr. Salman has alluded to some on his opinion on FX, but would love to get your views on that as well. So over to you, Saad.
Okay, thank you very much for that, Ali. So Assalamu alaikum, everyone. Thank you very much for the invitation. I've been on some of the other webinars so far, and I think they've been extremely insightful. So congratulations and thank you to KASB for organizing this series. I'll just start off with a quick disclaimer that all my views are personal views. They're not the views of any institution that I'm associated with. So coming on to your questions, Ali, about emerging markets and how to think about them. And there's been a lot of talk recently about debt relief. The G20 has been talking about it. The IMF has been talking about it. So has our Prime Minister as well. So I'll come on to that as well. But before I do that, I think it's important for us to think about the context for emerging markets from a top-down level. And that's very important to get the diagnosis right, to assess what's the right kind of policy response, and then what does that mean for asset prices, for FX, and for debt, and so on. So on that front, I really want to talk about only three things. The first is that as we've gone into this crisis, the starting point for emerging markets is a very weak starting point. So just like, with this unfortunate an analogy of the COVID-19 outbreak, that if you're fit and healthy and young, then it tends not to have much of an impact on you. But if you have other underlying conditions, other underlying weaknesses, then COVID-19 can be a lot more complicated. Similar with economies as well. If you go into a shock and you're in a healthy state, it's going to have, it's not going to have long-lasting consequences. But if you're already quite weak to begin with, it's going to be much more problematic. So that's the first point I'm going to talk about. The second is that actually emerging markets are not dealing with one shock. In fact, we're dealing with two shocks. And Salman Saab alluded to those, that you're clearly dealing with a COVID-19 and public health crisis and the sudden stop of aggregate demand globally. But you're also dealing with simultaneously a commodity price and an oil price shock. Oil prices fell the first leg because of slowing economic growth, but it became a supply issue as well. And that in and of itself, for many emerging markets as a whole, is significant in its own right. And I'll now speak a little bit more about that as well. And the third point related to the first two is, I think for many emerging markets, the second and the third round consequences will be far more profound and significant than the first round impact of the COVID-19 shock. And that's where the whole question about debt and debt sustainability, debt relief, all of that comes in. So let me start off with the first one about our starting point. And this crisis brings to an end the bull market and the expansion of the business cycle, which began in 2009 and 10 after the global financial crisis. So many people are comparing this crisis to the GFC. Because it was the most recent crisis that we have faced. And for emerging markets, the global financial crisis, wasn't nearly as consequential as it was for the advanced economies. The global financial crisis began in the developed world. It led to second round effects of the European sovereign debt crisis and so on. But emerging markets actually bounced back quite quickly from the 2008 crisis led by China. And part of the reason for that is coming into the crisis, emerging markets were looking far more healthy. In 2008, they had lower debt levels on the public sector level, on average. Growth was a lot faster as well. So we were coming off a period when growth was, much quicker. And that allowed emerging markets to bounce back, very sharply from 2009-10 onwards. Now, this is a very different starting point because actually emerging markets over the past 5 to 6 years, and I'm generalizing a bit here, but they've been in one form of crisis or another, right? So it began in 2013-14 when you had the taper tantrum and the tightening of US liquidity conditions. Then you had from 2014-15 onwards, you had the phase one of the global oil price shock. And that led to several economies and emerging markets going into a recession. You had Russia having a crisis, you had Brazil having a crisis as well, amongst others. And then you had from 2017 onwards, first Fed hiking rates, which led to significant dollar strength. And that all led to problems and a slowdown of growth in emerging markets. And then in 2018, we were all on our knees because of the global trade war. So already we've been coming into this having had a lot of blows in emerging markets. Growth was already slowing down. Not many countries have had the ability to implement structural reform over the past 5 to 10 years, partly because they've been dealing with slower growth globally. They've been dealing with these various phases and different types of crises, one after the other. And also as Salman had also alluded to, growth globally has been slowing down and aggregate demand has been generally weak. So that starting point for EM is quite weak. Global supply chains were already under the question mark after the trade war began. And I think that whole process will accelerate, and that means it'll be much more difficult for emerging markets to bounce out of this slowdown. The second point, related to this, that you start off and you go into a crisis, you already are in relatively weak shape. And then you're dealing with two shocks, not one. And, many people, so we've discussed quite a bit about the COVID-19 shock and its impact. But I also want to touch upon the oil price shock, because many people think of oil prices as being a pure zero-sum game. If you're an exporter in emerging markets, you get hurt. If you're an importer, you're going to benefit, and it's kind of zero-sum. Now, the research that we have done suggests that it's only a zero-sum game up to a certain point. So there is a level of oil prices where everyone is happy, that the oil producers are getting sufficient oil revenues to meet their fiscal needs and support growth. And the oil importers also have sufficiently low oil prices, so it's not inflationary, so it's not chipping away at real incomes. But when you have these kinds of sharp falls that we have seen in oil prices, partly exacerbated by this supply glut, the negatives globally can outweigh the positives, even for the oil importers. Because what happens is, to give you a concrete example, in Pakistan's case, there are large numbers of workers and expatriates in the Gulf countries who are responsible for sending back significant amounts of remittances. Now, if you start seeing job losses in the Gulf countries, you're going to see a negative impact from that. But more generally as well, what you tend to see when you have such sharp falls in oil prices is that global investment and capital expenditure, that tends to fall quite a lot. So then, even if you are an importer of energy, but you export capital goods, you export the machinery that's required for oil and gas exploration, you're going to be hurt from that as well. And that's exactly what we saw in 2014-15, that if you have enough large oil exporters going into a recession and global capex falls, then the negative consequences outweigh some of the positive consequences of that as well. And that was sufficient on its own to send several countries into crisis in 2014-15. And I think it just makes it much more difficult for emerging markets to grapple with this, because you were weak and you deal with not one, but two shocks. And the third thing, when you put those first 2 points together, is thinking about the second and the third order consequences. Because often what happens is that it's not really the first order impact, the direct impact, which hurts you, but it's the second and third order ones. So just like in that example of COVID-19, that, you know, the direct disease itself, that the virus itself not be as harmful if you don't have other pre-existing conditions, but if you do, you actually activate those other conditions. It becomes a catalyst for uncovering and unveiling the other vulnerabilities that you have, and they become far more important. An example of this is with the trade war. You know, economists for all of last year were surprised by how growth slowed down, how export growth slowed down. Because if you just look at the direct impact of the trade war, just the tariffs multiplied by the import volumes, it was actually not that large. It was only, I don't know, $50 billion, $100 billion globally, a very small percent of GDP. But it was a confidence impact, actually, that was far more negative and consequential than the actual impact of the tariffs itself. So for emerging markets now, we have to think about those second and third round consequences, because for a lot of the last 10 years where you had ample liquidity, emerging markets, you know, they're not all the same, but on average they have levered up. They've taken advantage of those ample liquidity conditions, and they've increased the levels of debt without using that debt in necessarily a very productive way. So the returns on that debt have been relatively low. So I think you should expect to see distress both at the sovereign level and also in extension to sovereign distress at the corporate level as well. So that's going to be, I think, a story that we'll be dealing with for multiple quarters. So the Fed will help asset prices, you'll get global liquidity improving, but it's not going to change the fact that you have a lot of emerging markets, both sovereigns and corporates, who borrowed too much during years when liquidity was available. And now they're facing a period of prolonged slow growth, and that's going to have long-term consequences. So you could see, some permanent damage to output. And if you look at the IMF forecast, for example, it doesn't really have a V-shape in emerging markets. So a lot of the fall that you have in growth this year is not fully made up next year. And as a result, we're going to be seeing a lot of emerging markets having to require assistance from the IMF, from IFIs, from multilateral sources, and so on. And this comes to some of your questions, Ali. You're asking about the debt profile of emerging markets, the need for debt relief, and so on. And I think very much you're right that that's where the conversation is going. So far, the announcements made by the G20 and so on, I think are more symbolic than substantive. I think it's, maybe not fair to call it debt relief. It's actually liquidity relief, because you still have to owe that debt. You just postpone the interest payment and you have to repay that with interest. It's on attractive terms, but it's more about liquidity than debt relief. And I think that conversation is only really in its early stages. I think there's more to go on that front, and many emerging markets are going to be in need of more serious type of relief. The other thing I would say is related to that, because you've come into this crisis with already high levels of debt, the emerging market policy response is much weaker than what we're seeing in developed markets. So if you look, say, Germany or Italy or Japan, their total stimulus packages, including guarantees, is between 15 to 30+% of GDP. Most emerging markets, because they don't have fiscal space, are seeing much more modest fiscal stimulus packages on order of 1 to 3% of GDP. And that's why also I think the recovery in emerging markets is going to be much slower this time around than in 2008. Now, in Pakistan's case specifically, you asked a little bit about FX and how that can how that's going to evolve. I'll make just a couple of observations there and then pass them to Salman. The first observation I'll make is that among the frontier markets, Pakistani markets have actually performed reasonably well. It hasn't really unraveled or been much worse. And I would say in the local market space for the local currency debt and the currency, it's been much better than many major emerging markets. So within that context, I think the performance of the assets have been quite good. The other observation I'd make is, when it's almost a year now, a little less than a year, that Pakistan went to the IMF, one of the problems correctly identified was of unsustainable policies of, managing the exchange rate. And I think very correctly, both the State Bank and the IMF identified that as a problem and committed to moving towards a more market-determined exchange rate, which is very important, I think. But since then, the rupee hasn't really behaved like a market-determined exchange rate, and that is volatility has been very low. So over the past 6 to 9 months, it's had not only very low volatility, but the adjustments we have seen have been very sharp, sporadic types of adjustments. So when the rupee weakened, it weakened in one day, and then it's come back down. So it still behaves like a very managed currency. And I think medium term, if we're to hold true in substance and spirit to some of those unsustainable policies that needed to be addressed with this program, then I think the rupee at some point will start to need to behave and look like a market-determined currency, because at the moment it doesn't really look like that. I think that's probably a good segue into Salman. You had mentioned ahead of the call that you have some comments to make on the rupee as well, so I'll hand it over to you.
Sure. No, thank you very much, Saad, for those very insightful comments. I'll just make a little bit of as I mentioned, some comments on FX. You're totally right. I mean, Pakistan assets have done relatively well compared to their peers. I think, obviously, the government's credible response, at least initially, has been a big factor, and the fact that we were able to link up with the IFI or the multilaterals quickly helped. But this FX angle is interesting because, as I shared earlier, we have to really understand what drives the dollar. And in these conditions, the dollar is not driven by typical FX developments. There is there is still some kind of hoarding going on in the dollar. It's not as extreme as in March. So linking up with a currency which is not behaving like a currency, is actually behaving like a reserve asset, has to be reassessed. And I totally agree. If you look at the market dynamics of PKR, you can't compare it with Russia or Turkey or other Brazils of the world or ZARs of the world, which are proper market-determined exchange rates. So we know in the EM space, and the investors know very well what kind of a market exchange rate volatility looks like. So it's important that I think that diagnostic is done, and I think otherwise what we basically end up doing is that we accumulate these stresses, and then they basically get unraveled in a very violent fashion once the imbalances build up. So just linking up what you said, Saad, I totally agree with you. I think the EM recovery this time around is a huge question mark around it. Firstly, as you said, the starting position, and I think your analogy of COVID makes a lot of sense, is much weaker. And also, I would add, is China is not doing a full-scale, indiscriminate stimulus. It is very calibrated. In 2008, China bailed out the world. Obviously, the Fed did quite a bit, but really it was China. This time around, China is nowhere near doing 20% or 30 percentage points of credit stimulus, which is being deployed in infrastructure spending. It's not happening. So that is not going to create demand spillovers for the rest of the world, especially in the EM space. And that means that the quality of the recovery is going to be weaker. If we get deglobalization, we saw the immigration issue come up again in the political year in the US. If deglobalization continues, then this export-led growth model is under a lot of pressure. A lot of these countries, especially when we sit in the UK, will have to start producing their own essential items. So there's a lot of debate going on internally here about the supply chain of PPEs or the protective gears or supply chain of paracetamol. I think there will be a widespread assessment of how these supply chains look like. And we have to be very careful in the post-pandemic world. And I think the focus on the domestic economy has to be important. And I think that also as a framework, I think we have to really rethink what is happening with the FX framework, because over the last 10 years, what we have seen is a lot of these countries, major EM countries, have moved away from managed exchange rates. And the last one to do that was Russia. And in fact, Russia has done quite well compared to the fact that oil has collapsed versus EM peers. And one of the major reasons is that it let the currency absorb the pressure, and it strengthened the other parts of the economy. So we have to, I think, really read the lessons of what's happening here. And in fact, as I mentioned, dollar is not a currency at the moment. It is a reserve asset, and it's not behaving like a currency at all.
Thank you. So your point, I think that's very insightful, that although I think the central bank in Pakistan does say that they don't manage the exchange rate, but your point is that the behavior of the volatility suggests that it is being managed because investors know how the volatility profile of emerging markets FX looks like, and Pakistan does not seem to follow that, suggesting some kind of mechanism to support it. And as Dr. Salman, your point is that it seems to be a wrong strategy, because the dollar right now is not behaving like a currency. It's like a safe haven. So you don't want to benchmark or peg yourself with something which is already behaving abnormally, because that will create stress in the system, which will eventually lead to some kind of collapse, like we have seen in the past, not so distant past. Saad, I want to go back to you and pick up on a point you made. In Pakistani press, and I think generally in the investment community, there's a general perception that the G20 debt relief, or as you said, the liquidity relief, has already been agreed on. I personally think that markets in Pakistan are already pricing that in. But you said that it's not done yet, it's at very early stages. Can you please elaborate on that?
Yeah, so no, I think that the G20 proposal as it stands, it's there. They have that is an agreed proposal at the G20 level, and I think the EM country has to make a request for that formally in order to be granted the liquidity relief. My point was in a broader context, because those countries that have genuine debt sustainability problems, their debt sustainability is not going to be solved by just postponing their debt repayments between now and the end of the year. That requires a much broader set of proposals and a structural architecture to dealing with it. And that's what I meant by that. We're at early stages. That if you're an emerging markets country that has a serious problem on its balance sheet, this liquidity relief will allow you to breathe a bit. It'll give you some breathing space for some months, but it doesn't solve your problem. And so I think to solve the actual underlying problem, that conversation is at an early stage. And it's a very complicated problem to solve, especially when you have a complex set of different creditors and so on. So that's what I think is probably going to take much longer to resolve.
It's not on the debt side, and because you cover a lot of emerging markets, based on their experience and the good examples which you're seeing, what would be your suggestions for Pakistan? Do you think we can tap international markets? What's happening from a regional perspective?
So as it stands from a liquidity standpoint, I'll say two things about Pakistan. First, if you look at the latest IMF report, they have approved the rapid financing instrument, the RFI. So that's a little bit over $1 billion worth. So according to that report, at least, Pakistan's balance of payments, the net dollar requirements, will be satisfied, already on the back of that. So in that sense, it doesn't seem that there is, an immediate urgent need to tap international markets. As it stands, the market for high-yielding emerging market sovereigns is not really there. So over the past few weeks, where we have seen issuance in the global capital market, it's mostly been, the GCC investment grade rated countries. So Abu Dhabi, Saudi Arabia, Qatar, all of these have issued, and there's been pretty good demand for their bonds. But they're a very different risk profile. Within the high yielding space, anything that's less than investment grade rated, it's still a very stressed market in a sense. It's not really opened up yet. And I think that points to something that we touched upon earlier in this conversation, that even though the Fed has de-risked global markets, the Fed is not buying emerging market sovereign bonds. So if the Fed is not buying that asset is still, it's not fully out of the woods yet. So that's the first thing I would say. Longer term, I would say that, look, debt sustainability for any country, including Pakistan, it's a long-term concept. Officially, the IMF believes that Pakistan's debt is sustainable as it currently stands. But the other side of the coin for debt sustainability is growth. It's not just your debt burden, but it's your ability to grow. And I think we have to think very carefully about what's going to be the growth strategy over the medium to long term. Because if you have a high debt burden, for an emerging market at the level of income that Pakistan has, it's reasonable to expect it to grow out of its debt, or at least partially grow out of its debt. And a lot of the conversation in Pakistan is about exporting again, replicating the East Asian tigers and so on. I'm not sure that that's an appropriate model anymore. You might partially be able to make some progress there, but as Salman has also mentioned, those days are kind of behind us. And there's a lot of headwinds to trying to pursue that type of growth model. So I think looking inward is important, looking at what your core strengths and competencies are, and trying to exploit those is going to be much more important to develop a growth model, not just copying what East Asian countries have done, 30, 40 years ago.
So that's an excellent point. And before I pose my question to Salman, I'll just highlight to the audience that you can ask your questions, you can post it on the chat, and then I'll just read it out. We now have 20 minutes for Q&A. Salman, Saad said that it's important to focus on growth, and you mentioned earlier that you think there are certain sectors which will come back, but there will be certain sectors which will not come back. And you said that those sectors which require people to be in proximity to each other might not recover. Now, one of those sectors is construction. So what we have seen in the UK is that although the UK government has not banned construction activities, the construction activities have automatically stopped because people are not willing to take that risk of going out and working in proximity with each other to build stuff. Now, in Pakistan, construction is the sector which has been identified as the main growth driver, which will take us out of this issue. So what are your views on that particular strategy?
I think, look, if you take the COVID dimension, and I can discuss that a little bit more detail, but if you look at the focus of the stimulus, actually, I agree with the focus of the stimulus. It's domestic oriented, it is employment oriented. And that's what we need right now. So people it's an economic shock on income, both on the supply side and the demand side, because we had to lock down the whole system. So if people can't earn, they can't, consume. It's if you put it very simply. So it's domestic oriented in its employment angle is important, which is, by the way, very similar to how other developed markets are looking at things as well. They are focusing on employment a lot. So the genuineness to focus on employment is important. Implementation is, I'm not talking about implementation here, but the thinking behind makes sense to me, right? So obviously implementation is another angle for Pakistan, but that's not. What is the COVID damage? So how are the UK thinking about this? So a lot of the exit strategies which are coming through on the supply side or the manufacturing side is that give the guidelines to make sure the social distancing can be maintained and the protective gear is given to these people before you can resume. Because what you don't want to do is that in these kind of activities, you create another cluster of infection. Let's not forget one of the major congregations which happened in Pakistan, when the infection was rising in the world, is now accounting for 27% of the case in Pakistan. So we have to be very careful that these congregations or the close proximities can trigger the way we are structured, socially organized as well. So having specific guidelines is important. So having social distancing upfront, keeping the employer on the hook that if you are not providing these conditions is important, severe penalties on it, and then the protective gear, so that you can minimize. So it's a necessary activity to take place. But where I'm concerned about is where people have discretion. So you have a discretion to go to the cinema, to the restaurant. So even if restrictions are lifted, which I think will be lifted, I'm not sure people will feel comfortable going there because of the fear factor. So there's that differentiation. So regulation, I think, which maintains social distancing and keeps the employer, on the hook for negligence is going to be critical if we are going to make this effective. So because what you don't want is basically another cluster appear because of such a social, close proximity activity. I think there is a solution. We just have to think about it very carefully.
Thank you. That was very clear. And we had in another webinar we had a couple of fund managers from China, and they mentioned exactly the point which you are saying, that over there, although the lockdown has opened up, but discretionary spending is very low because people are scared of going to restaurants. And what the fund manager was mentioning is that the government is trying to incentivize by giving free coupons for people to going to the restaurants, and the party members are going to the restaurant themselves to show that it's safe. So we have a few questions now. One of the questions is on central bank swaps, and I'm just reading the question. So central bank swaps may be a tool to provide USD liquidity to EM borrowers. Turkey, for one, is going in that direction. What's your view on central bank swaps as a tool for providing USD liquidity, US dollar liquidity?
Saad, do you want to take that one?
Sure. So I think dollar liquidity swaps can be a very powerful tool for those countries that are facing a genuine short-term liquidity shock. And I think the Fed this time around has been very quick to take a leadership role in the world to provide dollar liquidity when it's been most acutely required. So it's, in 2000, the Fed did the same thing, but this time around it's expanded the set of countries to which it's offering dollar liquidity swaps. If you look at the emerging market countries that are in receipt of these dollar liquidity swaps, they are generally on the stronger end of side of Mexico, Brazil, I think Korea has also received it, Singapore as well, if I'm not wrong. So these are countries that are already have a high level of FX reserves to begin with, and this gives them an additional, war chest to draw down upon for temporary requirements, and it also shores up market confidence. The Fed has not given these dollar liquidity swaps to those countries that have deep-rooted fundamental issues or have insufficient FX reserves of their own. So Turkey, for example, hasn't received anything yet. South Africa has not received anything yet. Because when you have a fundamental problem, not just a short-term liquidity shock, then the dollar liquidity from the Fed is really not going to provide you that much help. And it's not going to, and I think the Fed also doesn't want to take that credit risk directly as well. So it becomes a bit more complicated. So I think these are useful tools, they're powerful tools, but only where they actually solve the issue at hand. They're not going to solve a problem of sustainability, for example.
Sure. Dr. Salman, question for you from the audience, that do you expect another correction in the US equity market?
Actually, I do. So right now, if I put my investment committee chair hat on, and this is again based on published research we have been doing and been sharing with our investors publicly, is that we are long assets where we have central bank backstops, which is credit, really. So credit is the one which is being backstopped by the Fed and ECB as well. So we are more comfortable about that. So equities, we think, obviously with the earning angle and uncertainty about earnings, and also the fact that, the growth shock, we're not sure, where is the bottom of the economy yet. We have a bottom on the market temporarily because of the Fed, but I think the firm bottom is on credit. So on equities, we are concerned. However, I would mention is that there is a lot of dispersion going on now in equities compared to in March. So there is a lot of, winners and losers out of it, which are playing out. And I think it's important in terms of sectoral dispersion. So that was not happening in March. Now it's starting to happen. So the second leg of correction, if you will, I think will be over a longer period. Firstly, it's going to be low vol compared to what we saw in March, and it's going to be focused on more about the sectors who are exposed, because I think the systemic risk has reduced, and I think the Fed will probably do more if things deteriorate, and also we are seeing the fiscal stimulus being topped up. So the critical question for me in terms of when the equity market bottoms out is, what do people do with the dollars they receive in their bank accounts? If they don't use them, then frankly speaking, it's a waste of money, because it's just going to sit on the bank account and doesn't come back in the economy. So that is the critical question. We don't know what's going to happen yet, because there is school of thoughts on both sides there. So credit, we are more, more confident about at this stage.
What's your view on gold?
Gold, to be honest with you, has proven itself to be a great diversifier. And I think it has a strategic allocation space in any diversified portfolio. How the central banks are behaving means that gold is important. Real rates are negative and are likely very low. So I think in that sense, gold is a great diversifier. It's not a trading asset for me anymore. I think you have to have a proper portion of your portfolio, 10% plus, I would say, in gold. And I think it's important that it stays there, because we are still not sure ultimately how and when this excuse me, this whole stimulus will be paid for. Somebody has to pay for it, right? So it's not terribly clear to me how, who will pay for all this, big stimuluses we are talking about. So in that sense, gold, I think, is we have been long gold as a strategic diversifier in our views for the last 18 months now. So we continue to hold that position.
Thank you. So the question again for you, it's a follow-up on the question on the Fed swap. Do you think GCC countries can qualify for the swap from the Fed?
So, I mean, there's no official criteria which is published or made official to say who formally qualifies or not. If you look at the number of countries that have been extended the FX swaps from the Fed so far, they are either developed markets or they are large and relatively systemically important emerging markets as well, or it's those markets that have an ample stock of FX reserves on their own. So I can't say whether GCC qualifies or not, because there's no qualifying criteria. But if you to the extent that they are selectively, I think not all GCC countries are the same. First of all, I'll say that. But to the extent that you have a country that is systemically important, is suffering from a genuine short-term liquidity problem, not a deeper structural problem, and if it's politically feasible, then such a country would probably get an FX swap. But not that any of the GCC countries have publicly requested this yet. So I would qualify that answer.
So two more questions. One is the question which we hear quite a lot is that, do you think that all of this stimulus will fuel inflation? And secondly, the role of agriculture. I think it's a pertinent point that we don't hear too much about agriculture and I've not seen many countries talk about supporting the agriculture at this time. In the case of Pakistan, that's major source of employment. What's your opinion on the agriculture sector? And so the second question is on inflation.
I guess I can share with you our views. So we are looking at food supply chains very, very carefully, because the longer this disruption continues, there will be, I think, some serious concerns which can be raised. To give you an example, UK imports 40% of its food. So, so what we saw is that a lot of countries have become very internally focused. Obviously, it's a crisis situation. So I would not be surprised that once things settle down, that there is a thinking about management. So you will see move away from efficiency and saving pennies to understanding the whole risk management framework of essential items, because it's a key part of your social contract. So I think it varies from countries to countries. But I think when it comes to Pakistan, I generally feel that this is an area which can be stimulated. And Pakistan has been lucky in that front, that Pakistan is not a major importer of food. So even then, because we are closer to our sustenance levels, so food management has always been very important for us, and as you know, it can become a very controversial topic as well at times. But it has to become very strategically thought as well, because given our resources and given our focus, it's actually going to become very important that we have food sustainability, because our balance sheet is weak, and this COVID shock, as Saad rightly pointed out, is actually more dangerous because it exposes existing weaknesses. So you don't want to add food onto it, because then you are going towards a full-fledged social unrest situation. So in some developed markets, I think this discussion has already started, that what are the essential items, what kind of, even if it becomes a bit more expensive to produce and consume, we should be going for it because of the risk management. And it actually is positive for inflation, right? Because you will be then not relying on the cheapest source. You will be relying on where the source is and diversifying your sources, right, of supply. So in that sense, there is this angle of inflation. The another angle of inflation is that after the 1918 pandemic, actually, this is a great study done by the Fed. What we saw was that labor becomes powerful versus capital. So if labor in the US, for example, which does not enjoy as much rights as it does in Europe, gets, i.e. the companies have to pay for pensions and pay for healthcare and give safety nets, then those companies of the world relying on very, very cheap labor, which they can chuck out at a moment's notice, are going to be, again, a problematic from a policy perspective or social policy perspective. So that's another source of inflation. The last one is obviously monetary stimulus all over the place. But I do caveat that. The caveat is that we see Japan, we see Italy, who run debt ratios of 130% of GDP. The Bank of Japan balance sheet is 100% plus of GDP. Fed is just reaching 30%, and we still see no inflation. So those two worlds may collide, and we may see, specific components of inflation, especially in food, especially on essential items, because they are done a little bit more inefficiently, but to diversify. And I think the lesson for Pakistan is to reassess your food supply chain, understand that we cannot allocate resources on food items which are not essential and not productive or profitable. It hurts the country, really. It may benefit some segments, but it hurts the country. And this COVID crisis shows is that when you are in a weak situation, you are going to get exposed. And I think this COVID crisis is actually a big reminder and a wake-up call for everyone that you have to be healthy as a country, because these shocks can occur from out of nowhere.
Thank you. Saad, any comment on inflation in the system?
No, all I would say is that we need to differentiate between inflation of goods and services and wages and inflation of asset prices. So after 2008 crisis, there were a lot of cries that we'll see inflation because of all the money printing, and we did see inflation. It just wasn't the inflation people expected it to be, because it was inflation of asset prices rather than consumer basket inflation. So that's the other, I think, question on which the jury is out. Are we just being set up for markets that will be inflated disproportionately away from fundamentals because of this liquidity? And will also markets become very dependent, over-dependent on policy going forward? We know that global markets have been so dependent on the Fed and monetary policy over the past 10 years. But this type of liquidity interventions and injections might just take that dependency to a whole new level. So those are important questions, I think, to think about.
Thank you. With that, we have exhausted 1 hour, and we have taken a lot of your time on a work day. There were 3 main points for me from this talk. The one is the significance of the Fed put, the floor which the central banks have provided on certain assets. The second one, Saad's comment that emerging markets are facing not just one hit from COVID, but the other effects, second round and third round effects, which have now also impacting the economies. And as both of you said, that COVID exposes our vulnerabilities, and emerging markets were in a bad shape even going into it. And I thought what was very insightful, again, from Dr. Salman's talk was your comments on oil, that you think that there could be a spike in oil prices, and the issue is not much about demand, it's more about the short-term supply, short-term storage capacity. And if this leads to destruction of supply, then that could lead to a squeeze in prices, and we could have more volatility in oil prices going forward. Thank you so much for your time. As always, it was a pleasure to having you over. We had 60 people who joined the call. Have a good day, and I'll share the recording of the webinar with the people who joined the call.